In early April 2024, a discreet meeting takes place in Brussels. No cameras, no statements, no leaks. Finance ministers from the world's most powerful economies sit around a table discussing a problem that has been frozen in place for more than 2 years. Not Ukraine, not sanctions, but money. $300 billion. Since early 2022, Russian central bank reserves have been immobilized across Western financial institutions. Not confiscated, not transferred. Simply locked in place, unreachable, unusable, suspended in financial limbo. The assets sit quietly inside accounts at Euroclear, in Belgium, the Federal Reserve Bank of New York, the Bank of England, and several European central banks. For 2 years, that frozen money functioned as leverage, a signal, a bargaining chip. End the war, normalize relations, and access could theoretically return. That assumption mattered more than most people realized. By spring 2024, that assumption collapses. Ukraine's finances are deteriorating. Western aid is slowing. Political divisions inside the US Congress are delaying new funding packages. European governments face voter fatigue. Something has to fill the gap. Inside that Brussels meeting, a solution is approved, one that avoids outright seizure, but crosses a different line. The G7 will redirect the interest generated by Russia's frozen reserves, roughly $3 billion per year. The principal remains frozen, but the income will be sent to Ukraine. On April 30, 2024, the decision becomes public. In the Western press, the response is almost celebratory. Headlines frame the move as innovative, lawful, even elegant. Russia's own money, now helping rebuild what it destroyed. But thousands of miles away, in places with no connection to the war, the reaction is very different. In Beijing, Riyadh, New Delhi, Abu Dhabi, Brasilia's central bankers are not applauding. They are asking a single, uncomfortable question. If this can be done to Russia, can it be done to us? The answer, from a legal and operational standpoint, is obvious. Yes. If sovereign reserves held in dollars, euros, or pounds can be frozen, and their income redirected, then those reserves are no longer neutral. They are conditional, political, vulnerable. That realization doesn't trigger panic. Central banks don't panic. But it does trigger action. Quietly, gradually, methodically, they begin reducing exposure to US Treasury bonds. Not through headlines, not through sudden liquidation, but through steady, persistent selling, month after month. By the end of 2024, 8 months after the G7 announcement, foreign ownership of US Treasuries has declined by roughly $400 billion. China reduces holdings by nearly $90 billion. Japan sells close to $100 billion. Saudi Arabia cuts more than $30 billion. Belgium, which acts as a custodian for foreign funds, sells tens of billions more. Offshore financial centers linked to Asian institutions quietly follow. This is not routine portfolio rebalancing. It is not yield chasing. It is not market timing. It is strategic withdrawal. To understand why this matters, you have to understand what the US Treasury market represents. For decades, it has been the backbone of global finance. The deepest, most liquid, most trusted pool of debt on earth. Governments, pension funds, insurance companies, and central banks relied on treasuries, not just for returns, but for certainty. Before 2022, foreign governments held roughly 1/3 of all US government debt, owned by the public, over $7 trillion. China and Japan alone held more than $2 trillion combined. This structure enabled something unique. The United States could borrow at scale without consequence. Large deficits didn't trigger capital flight. Debt expansion didn't spike yields. Demand was constant because trust was constant. That trust was not written into law. It was assumed. Yes, the US had frozen assets before Cuba, Iran, Venezuela, North Korea. But those cases reinforced the rule rather than undermined it. Those countries were openly adversarial, isolated, already sanctioned. Russia was different. Russia was integrated. A major energy exporter. A G20 economy. A permanent member of the UN Security Council. And crucially, a country that had deliberately accumulated Western reserves precisely because they were considered untouchable. When those reserves were frozen in February 2022, central banks noticed, but they waited. When the income from those reserves was redirected in April 2024, waiting stopped. From a legal perspective, officials insisted this was not confiscation. From a financial perspective, the distinction was irrelevant. If you cannot access the principal and cannot receive the income, ownership is theoretical. At that moment, the Treasury market stopped being politically neutral. And when neutrality disappears, reserve managers adapt. The selling that followed did not crash markets. That's intentional. Central banks sell slowly to avoid damaging the value of what they still hold. What matters is not the speed, it's the direction. And the direction changed decisively after April 2024. This creates a structural problem for the United States. Each year, the US government needs to finance roughly $7 trillion in Treasury issuance, about $2 trillion in new deficits, and $5 trillion to roll over maturing debt. Historically, foreign buyers absorbed a large share of that supply. Domestic institutions absorbed another portion. The Federal Reserve filled the remainder during crises. Now that equation has inverted. Foreign central banks are no longer net buyers. They are net sellers. Domestic institutions are already saturated. Pension funds and insurers cannot double their Treasury exposure without risking balance sheet instability. Households are not stepping in. Foreign private investors face the same political risk concerns as central banks. That leaves one buyer, the Federal Reserve. By late 2024, despite official claims of balance sheet reduction, the Fed's Treasury holdings have quietly increased. Not because of stimulus, but because supply must be absorbed, or yields rise uncontrollably. When a central bank becomes the primary buyer of government debt, the system changes character. Markets become managed. Prices become signals of policy, not demand. This is debt monetization, not in theory, but in function. And monetization carries consequences. As the Fed absorbs more treasuries, liquidity increases. Inflation pressure builds. Real returns fall. That makes treasuries less attractive to remaining foreign holders, encouraging further selling. The feedback loop tightens. Meanwhile, reserve managers are not simply holding cash. They are reallocating. Gold purchases by central banks have surged to levels not seen since the collapse of the Bretton Woods system. Physical gold held domestically cannot be frozen. It cannot be redirected. It carries no counterparty risk. China, India, Turkey, Poland, all increasing gold reserves. Some openly, some quietly. Others are shifting toward non-Western currencies, commodities, or bilateral settlement systems. The dollar's share of global reserves declines, slowly but steadily. This is not a collapse. It is erosion. And erosion is harder to stop. Over time, Treasury auctions become more fragile. Yields drift higher even as the Fed intervenes. Interest costs on US debt expand faster than tax revenues. At some point, interest payments begin consuming a destabilizing share of the federal budget. At that point, choices narrow. Raise taxes sharply. Cut major entitlement programs. Inflate the debt away. Or restructure obligations. None are painless. All reduce living standards. This is not about Russia. Russia lost access to $300 billion. The United States, in exchange, weakened the foundation that supported trillions more in privileged borrowing. Trust is not a resource you can reclaim with policy statements. Once reserve managers adapt, they do not reverse course easily. History offers a parallel. In the early 20th century, Britain weaponized financial dominance during wartime. It worked, temporarily. But neutral states learned. Capital shifted. Within decades, London's financial supremacy gave way to New York. Financial dominance often outlives the decision that ends it. But the end begins quietly. What happened in April 2024 was not dramatic. It was procedural, legal, carefully worded, but it marked the moment when sovereign reserves stopped being unquestioned. And when trust disappears, markets don't collapse overnight. They move on. If you want to understand where this leads, what happens when Treasury yields push toward 8 or 9%? When debt service overwhelms fiscal capacity? And what options governments actually have when reserve status fades? That's what the next video is about. Subscribe to Finance Matters. Because the story of global finance is no longer about growth or innovation. It's about trust, and what happens when it breaks. At Finance Matters, we explore history, economics, and perspective without hype or speculation. If this video added value, subscribe to the channel, and press the bell icon to receive future educational releases. Your support helps keep this content independent and informative.